All right. Good morning, everybody. TGIF. Mixed bag. We got nothing really in the green that's going to help us out at this point. Hong Kong is down 1.25%, and the Dow is down 0.25%. Everything else is flat, waiting on PCE. Seemed like yesterday, when I was looking at Finance Juice, it had PCE on Thursday, but after I had closed the stream, when I went back to Finance Juice, that was Friday. That was today. It's a big one. It is the biggest one on the week. But we're going to get a lot of data today. And from here on out, it's going to be short weeks. We're closed Monday. Obviously, it's Christmas. We're closed the next Monday because that's New Year's. So you can see a lot of these are medium impact to high impact probability opportunity. Important U.S. inflation indicator. This is going to go to the heart of what the Fed is working on, especially with that comment that they started promoting that they could possibly cut even if they don't think they need to cut, since they already understand that their indicators are a lagging indicator and that by the time they saw a reason to cut, it would already be too late. This is the CME Fed Watch tool. Right now we're looking at January. Still have an 85% probability that the January FOMC will not be a rate cut. This is March, and they have a 71% probability of a rate cut starting in March. So that would be the first cut. But these numbers haven't changed in a little bit, like from yesterday to today, nothing. In the past week, we've kind of priced in that cut a little bit. In the last month, you can see we went from a 27% chance, increasing more than 50%, to now having a 71% chance. So this is kind of what you want to keep your eye on. See if they start unwinding this, right? Right now, there's a little exuberance on the cut. If they start to unwind that, we'll see the S&P go down. If they start pulling it forward even more, then we'll see them increase this January FOMC date. It's the Jan 31. Between now and then, there's a lot of data going to be coming in that's going to help shape whether or not we'll get a cut here. So this is what we want to keep our eye on. We're just above the volatility trigger. The put wall is at 47.68 and zero gamma is below the weekly pivot point. That is in range, but it's unlikely that we're going to go that far, even with PCE today. They are a little worried. They're hedging this today. Remember, hedging is insurance, and insurance is cost. You don't get free insurance. You have to spend money on it. And, if you consider it as a trade, it's a trade that you're putting on hoping it loses. And I don't think enough people grasp that, right? We get to talk the fancy language all the time, all their hedging. But when we get rid of that fancy language, it's just a promised loss. It's a trade that you're putting on that you hope doesn't work. It's the cost of doing business. Now I get it. A lot of people, they're in and out day trading. They're not carrying any trades. They don't need a hedge. And if that's the way you've ever traded, then you really might not grasp the reason why you need a hedge. But for the rest of us, having insurance protects our accounts and lets us sleep at night. When there is uncertainty over a big move, like an economic event, the concern is that it may have taken you weeks to build your position, so you don't want to unwind it, which is also going to take you weeks. You're just going to stay in. But that leaves you exposed to considerable whiplash. And rather than just take it on the chin, you put a hedge in place. If you're, heavily short, then you hedge against an upside move. And if you're heavy long, you hedge against a downside move. Makes perfect sense, right? But just like house insurance against a fire, you pay that every year, hoping you never get your money back. Because the only way you're going to get to claim that house insurance is if your house burns down. And you don't want your house to burn down just to get the insurance. Now, we're not guessing or assuming that they're hedging. We could assume that they're hedging because this economic data point is a big one and they're concerned. But we can see it. We know for a fact that they're hedging because we have a market maker move this morning. Now, not all broker platforms have a market maker move, but if they have options, you can go in and see if there's a market maker move on your own. This is something that Tom Sosnoff's crew came up with when they were building out the Thinkorswim platform. The way to identify if there is a market maker move will be to check the optionality on the average implied volatility here. So if your broker has options, just look at the front two expirations and see if the front one is higher than the back one. If there's backwardation here, if the front one is higher than the back one, that is what they call a market maker move. Now you can do the math between these two to see what that real number value is. But just recognizing that one is bigger than the other is really all that you need. On Thinkorswim, you'll find the market maker move label right up here. Now, I've reached out to them and said, this would be a simple fix. You should fix it. If there's no market maker move, you won't see the 3M with 0 written here. You just won't see this whole entire thing at all, which makes it seem like there's something that you have to go in on your settings and turn it on. You don't. It'll show up. If there is a market maker move, it will show up there. You don't have to turn anything on. So a little frustrating, because I've had people ask, hey, where do I find it? I don't see it. Looking at, say, Apple or something like that. You don't see it if there isn't one, and that's it. So we know they're hedging. We know that they're concerned. And when it comes to big moves, surprise moves in the market, surprise is the key. Markets don't like surprise. If we get some random bit of news coming through the wire that catches all of us by surprise, we see a real big move because nobody had time to hedge. People are scrambling to cover, and they're all trying to go long or they're all trying to go short at the same time. If everybody hits the bid, then we got to chase it, right? We're hitting at the bid and below. And if everybody's hitting the ask, then we're hitting at the ask and above, chasing it, trying to adjust our position because we were caught off guard. But when we anticipate or expect a big move in the market, we hedge ourselves to the eyeballs. Well, now we're not scared. We're not going to be caught off sides. And no matter what the news is, we don't have to scramble. So this can blunt or shunt the anticipated impact of a big event. I stress this point because I remember when I was newer and people would warn kindly, nicely, hey, watch out. You know, we got this economic event tomorrow. Careful what you swing trade because we could get some big moves. And of course, I'd be a little concerned, but I'd also be thinking, oh, hey, maybe I can trade that. It'll make a big move. I could buy some way out of the money options. We get this big move. Those cheap lotteries will make me some money. But you know, it seemed like when we would get those really big warnings, we rarely ever got the really big move. And I didn't grasp the why behind that. All they said it was going to be big moves. So when we know they're hedging, we could see a big move in the report that lasts within the 5 or 10 minutes of that volatility. And then that's about it, right? It just kind of dies back down again. Even hedged, you'll still see where we make a big move and it sticks and it continues to hold that move and even increase that move through the day. Usually that's when the big news changes the complete picture. That we no longer have, say, you know, a strong dollar, or that the 10-year found support and started to rally, that core inflation numbers have changed. Something fundamentally has changed the picture, right? And then everybody's trying to redirect and change out their positions, which is kind of what we got with Powell at that last FOMC when he didn't, he came out really dovish and kind of validated all of these rate cuts that the market had priced in between November and December. There was still a lot of analysts that were on the fence who are no longer on the fence. And then we really popped. So let's lay these levels out for today. Recognize the low volume with the market maker move. That tells us that they're worried, they're sitting out, they're hedging, they're waiting for this data point to come out today. So if you weren't listening to me, you had already got up early, you come in trying to trade in the pre-market with futures, you could see these things for yourself just looking at the cumulative overnight volume and recognizing that there's a market maker move and being able to, you know, identify on your own that volume is light, the market is waiting for this data point to come out, and trading might be a little sticky. Not too big of a deal, right? We're still flirting with last week's high. We keep coming down and interacting with it. 47.91.75. Might as well call it 47.92. That's a cog line. COG, center of gravity. 92, 32, and 11. All of them. The 50% mark of last week, the halfback, 47.22. And the upside move, the 1, 2, 3, 6, 48.25. We're still a considerable distance from that 10-week moving average. And we still have positive market breadth. We're still holding above that 10-period weekly moving average. You know, I was looking up this same tool on TradingView, and one thing that they allow you to do on TradingView is rather than picking the NYSE or the NASDAQ, if you open up the CVI, you can just tell it you want all US, which is nice, right? That way you're not torn between, gosh, should I do the NASDAQ, the MX, the NYSE? Just do them all. US total. Yeah. Yeah. Now, I really suck at trying to code ThinkScript or PineScript. So I don't have one pimped out here yet. Yet is the keyword. But I'm going to try to get one of these CVIs built like my CVI here on Thinkorswim with Bollingers on it and the 3 moving averages. It's not a must-have, but at least having that 10 on there. Strong above the 10 and parabolic when we get outside the Bollingers, like we did down here. You know. Or like when we were there. So for today, we're really close to the middle of the ADR range. The ADR range is still 40 points. That's from Globex open, basically. 20 points to the upside and 20 points to the downside. That makes a 40-point range there in the middle. If we drive 40 points in one direction, we could get to the yellow line on the downside. That would actually be the 10-day moving average. And to the upside, it would be all the way up here at 48.35. So we would actually get above that Wednesday high. I find it really hard to picture that because this solid green line is one of the major voodoo levels. I believe they call that one forest. Not 100% sure. I think that's what they call it. Maybe forest is this other one, but I think so. Either way, that big green line right there, 4808, 4809, whatever we want to call it, it's one of the biggest voodoo lines that we have. So it was a struggle to get through it in the first place. Once we did, it held as long as it could as a support, and now we're back below it again. And I think it's going to be really hard to get back above it again. Doesn't mean we can't, especially when it comes to economic data points like today. Technical analysis and pivot points take a back seat to order flow. And when the data comes out at 8:30, we could punch through any pivot point in our path. So, you know, there's no expectation of any quote support or resistance or anything like that. Those take a back seat, right? We get through the volatility and then we'll see about those pivot points. So we could punch through it. The thing is, though, I think it would take something as powerful as an economic data point to get us through there at this point. And the call wall is at 5,048. So if you think about where optionality is here, we're in the lower end of it. everything in the options structure is pointing higher than where we are right now. If we did break down from here, there's nothing down there. We could fall through it really fast. So that's a little bit of a threat to the downside. That would be the 0 gamma line, by the way. That's where we would change from being in positive gamma and then now suddenly being in negative gamma. And hopefully, you know, you kind of see the stopping point between those two, right? Positive above, negative below, 0 right in the middle where we transition from one to the other. That's the transition point. It's also a cog line, 47.32. Amazing how that just keeps coming up. It's also the weekly pivot point. So if we get these cog lines off of there, they're just loud. They take up a lot of our attention. We got a voodoo line at 47.70 and 47.50. We have an MDP, a missed daily pivot. Any move to the downside is going to interact with that, 47.80. When you get rid of all the noise, this is what we have left. It's just about a 50-50 right now. We're not leaning closer to one side or the other. But where are we going today? One of those red lines. Statistically, we're going to go to one of those red lines 85 to 90% of the time. So it's possible, and we've certainly seen examples of it before, where we don't go to one of those red lines, that we just kind of hover, especially on a Friday going into the close before a short week. We could just chop about in the middle and never reach either side. That's absolutely possible. But what's more likely is that we'll hit at least one side and or both sides. On Wednesday, for an example, we hit both sides. What I do when we have a market maker move, this is giving us a projection of another $19.50 because the current market maker move is 0.41%. So we can take the $40 expected move that we already have, and we can add that $20 to that number. And you can do it two ways. You can split it. It's $20, so we can go 10 higher here and 10 higher there, or 10 lower here. That would give us our additional 20. And then you can also just take it 20 more points in one direction and 20 points in the other direction, just like we do with the ADR. So from 48.35 to 38.45, and 48.55. It's $10 and then $20. Do the same thing in the other direction. 47.56. and 47.36. That gives you your full ADR with your market maker move in there. And it doesn't look like much, right? Until we bring it out here and kind of get some perspective. So we can see that Wednesday's sell-off in a little better focus here and how wide this move is projected to be today. Just keep in mind, they're hedging, right? So we could see a little bit of volatility and then come right back to the mean because they've hedged the heck out of it, and there's just no shock and awe or surprise to send us to these depths. $10-day, 30-minute volume profile. If we break Wednesday's low, there's really nothing down here to help us out. And we're very likely going to go to 4,700, which is the value area low on the TPO. And I bet if I set this back to 70, it would probably be the same thing for the 10-day. Yeah, pretty close. Close enough. We're starting to lose the shape, but for the moment, we still do have a classic B shape profile. We're going to lose more of this volume as the day goes by. And by Monday afternoon, we're going to have a much shorter profile if we don't expand to the upside. Because we're going to lose all of this volume. And by Monday, that should get us to around 46.80. We have a new VPOC from yesterday. $47.83. And look how tight this range is today. They're wound up, ready to go. So this noisy thing down here is called the RSI Laguerre. It's got two indicators in it. The cyan line is a 2-period RSI. The RSI creator back in the day had talked about an extreme RSI that basically would magnetize across the top or across the bottom with no middle ground. The only thing in the middle was just transitioning from one side to the other. And that when the market was bullish and we were magnetized across the top, it was just max power, right? Like pedal to the floor, everything you got kind of push. And when it was magnetized against the bottom, then you were full bear, just everything that you could give it 100% bearish. If you consider that transition that we had after the sell-off Wednesday when we were grinding our way back up, that bit of a rebound, you can see how the RSI mostly stayed in that upper quadrant. That's that bullishness. That's the RSI side of it. Now, the creator of this indicator, Mobius, he did a little bit of magic to try to smooth that RSI out a little bit. Because if you've ever looked at a real 2-period RSI, it doesn't look as clean as this, right? It's really nasty. This is bad enough. So he smoothed it a little bit. I mean, that's part of it. And the other part is the orange line behind there. That's the fractal side. When we're above 60, we consider fractal as energy. And when we're above 60, we basically have a full tank of gas where we've got all the energy, a full battery, however you want to say it. We're maxed out, ready to go. Now, by using this indicator, we learned a lot about how a market will gain energy and how a market spends energy. One of the things we learned from using this thing is that a market that is sideways can build energy. And that when markets make a move, it isn't always done with energy behind it. Sometimes those moves are building energy, not spending energy. Now on this time frame, we're not getting a lot out of it, right? It's just choppy. We can see the back and forth, the give and take. But we could go to a higher time frame and reevaluate this range from the overnight, and we could put that into context of how much energy do we have, and are we fully loaded? Pretty sure we're fully loaded. There's signals that go with this. There's a lot of information that goes with this. Look in the Thinkorswim workbook. I've got pictures in there showing the triggers for trades, how to read it, all that, right? You find it in the Thinkorswim workbook. Various versions. I got all kinds of things that go to the RSI gear in there. The point of bringing it up is we got a lot of energy wound up in this market. We're ready to go. So we're still 4 3/4% above the 10-week. Even that little move that we had on Wednesday wasn't really enough to change that yet. We're still considered very close to being overbought. Just remember that that doesn't mean reversal. It very often just means a pause from going higher until that 10 catches up. When we get a new week next week, the 10 will move, right? From its current location now, we'll get a new print, and that 10 will be in a new location next week. I know it might be a little hard to grasp for newer traders, but think about the fact if we turn an indicator into a dash for the whole week, so that's 1 week right there. The 10 stayed there all week. Next week, it's going to get recalculated and it'll be in a new spot. There's where it was last week, the week before, right? It just stays in that spot the whole week. So next week, we're going to get a new print. And really, if you think about where we were Friday and where we are now, we haven't really gone anywhere yet. We got to get through the end of the day today. But price is going to still recalculate. It's going to change the location of that 10. So without price selling off at all, we're going to get a lot closer to that 10 by Monday. All right, we're working on breaking out on the NASDAQ and the S&P. Still got to get through the news, but We're coming right up into yesterday's high. So inside day breakout, clean above VWAP, getting a little stretched. Dollar's trying to come up with us. So this is going to be, you know, a little cause of concern. We're going up with the dollar. Well, the dollar index, but close enough, right? So this is that sea change that we've been talking about, how we can't necessarily rely on these indicators the way that we have been over the last 18 months. Keep your eye on the 10. We want to see the 10 continue to sell off, but that's going to be also then that we have stocks and bonds going to the upside at the same time. Risk parity would be dead again. It's still dead. The other day it was nice. We had bonds up, stocks down, but there's still transition. If you're going to play the econ, this is a really decent setup. I got the 2-year on the right in blue, the Dixie on the left, and the ES in the middle. The idea behind this is that when we get the data print and we see that big move start, we want to see if it lines up with an opposite move in the 2-year and in the dollar. So the ES up, dollar down, the ES up, the 2-year down, right? So these two on the side should go down while the one in the middle should go up, or vice versa. Here's FOMC for an example to kind of lay that out, right? Wednesday, we got the print at 2 o'clock. The ES headed to the upside, the Dixie headed to the downside. And here's what the 2-year did that day. These work in the pre-market. So, you know, there's not a lot of tools that we can use like the weighted AD, cumulative tick, regular tick. We don't have those tools, but we got these. So even in the 830 pre-market, you can still see this dollar move and 2-year move. And on finance juice, this is often what they show when they, you know, highlight that there was data that came out. So if we were to just, you know, I don't have an example to show this morning, but it'd be the red background, the 3 charts. That's their setup. All right, so this is the heat map this morning. The fangs stand out really easy. The Magnificent Seven are the biggest boxes on the screen. So it makes them really easy to find. Microsoft, Google, Meta, Apple, Amazon, Tesla, NVIDIA, AVGO. Those are the NY Fang names. And really, we could see how kind of flat to negative it is out there. There's a few places in green, not much, right? 0.16 isn't much for green. But things like Tesla, more than 0.75%. or semiconductors between MU, MRVL, AMD. We don't have an S&P 100 to use. So what you can do is use the filter and change it by market cap to where you got 100 there, or as close to 100 as you can get. 106, that's close enough. So we were looking at the NASDAQ. Now we're looking at the S&P. Still have it set to pre-market change. Kind of get a little, got banks, right? The NASDAQ 100 doesn't have financials in it. So this kind of gives us the missing piece. It's still more negative than positive. But that huge breadth that we've had through the week, it's not here yet. So, it just kind of reaffirms that concept that we were already talking about, that the market's in hurry up and wait. One name in the S&P is up more than 0.5%, but only two names are down more than 0.5%. So more of that flatness. There's just nothing there. Four names in the NASDAQ are up 0.5%. The Dollar Tree being one of those. And 11% of the NASDAQ is down more than 0.5%. China ADRs down 5.5%. That would be your Baba, Baidu's, JD, PTD. It's very likely, though, that not all of them are down, right? It's probably more likely that just one name took the rest down. So let's take a peek. Big old dark pool print on Baba here, working on getting that gap closed. It almost got it too. I'm not seeing which one was the cause, and I'm sure it'll be in the news. One of those names, very likely has had some news on it that caused this to happen. Regulatory concerns after China unveiled draft rulings aimed at curbing spending on online gaming, which has negatively impacted gaming and internet stocks. And I was just reading about their import exports on vaping products or tobacco products, also over the impact of teens. So this thing on gaming was because of teens, and then the ban on vaping with teens hurt a lot of their companies. So at least now we know why the China ADRs are down. Airlines also getting hit. By itself, it was kind of due, but in the bigger picture, it's more than just air jets, right? Is it just jets or is it transportation? That'd be the bigger question. And does that also hit, like the frivolous spending, casinos, cruise lines, resort hotels? So I'd be a little concerned with that. And it probably ties in with crude moving up. Yeah, okay, it's up a little, not enough yet to really cause concern. But, rising fuel costs would be the first blush bet on why we're seeing jets down. So crude is up a little bit, 0.75% this morning, but it's still within this range. It just hasn't gotten anywhere, right? Back above the 3, still holding above 10.20, but the 10 and the 20 haven't crossed back over. And we're still underneath that 75-65 level. So sure, it's a little positive. Nice recovery from yesterday. It's a 10 bounce, but now we got to follow it through. And it looks like they're trying to bring it back again. This little bit of a rebound. If we look at it on the daily, we're in this really tight zone here. That's healthy digestion, and it wouldn't surprise if we come out of that and we keep going. As long as we don't start getting some really nasty fuel costs, well, looks like Jets got more to it. Be a decent swing. So we got a few issues with Amazon. It's just kind of range bound. Halfback has pretty much played out. We're looking to see if this is going to rally back up and take off. But XRT is down, retail. Might not just be Amazon though, right? Worth taking a look at Target, Walmart. Remember Dollar Tree was moving around. That could bring us back in the other direction. Other names like Dollar General. Growth over value, right? So we can see we're gapped down this morning. So value this morning is doing better, outperforming growth. We would expect the fangs to be down with this, or at least flat sideways. And we got 8 minutes until that data point comes out. Yeah, Google's not down. Looks like it's ready for inside day breakout. Microsoft's a little soft. From where we closed, Apple's up a little bit, but certainly not ready for inside day breakout. But Tesla is already taking the breakout. So Google up, Tesla up, and NVIDIA ready to break out. Half the fangs. If we can at least keep the other half from just straight selling off, all they got to do is hold the line. They don't have to rally. Otherwise, it's just going to take us back to, watching the clock and getting the econ. Yeah, I'm going to be here. I've got trades that I'm going to manage, and I'm looking for some shenanigans, maybe in energy. So I'm going to be here anyways. They probably won't be, extended briefings, but we'll be here. For anybody who won't be here next week, enjoy your holiday. Everybody be safe, be careful, have a good weekend. I'll see you all next week.